FY24 was a blockbuster year for most product companies in the industrial space. It was characterized by record-high order books, strong government-led domestic capex momentum which offset the slowdown in exports and margin surprises. In the first quarter of this financial year, the top-line visibility across segments is very strong. Revenue is expected to grow in double digits driven by execution of orders received in the last couple of quarters. While operational efficiency, favorable mix and better pricing could support margins, though a rise in commodity prices could place spoilsport. Nevertheless, margins are expected to expand on a YOY basis. Companies may continue to benefit from a strong inquiry pipeline, especially in T&D, data centers, EV, railways, amongst others. However, order inflows may see some moderation given the elections, which is largely expected. For ABB, process automation and electrification segments are expected to drive growth. Order backlog of nearly 8,900 crores will support revenue growth of nearly 23%. With the base quarter EBITDA margin at 13.9%, we anticipate an expansion of nearly 330 basis points, resulting in a 46% uptick in the net profit. For Siemens, the company could see its revenue rise by 19% on account of healthy growth in smart infra and mobility segments. Margins may expand by 240 basis points to 14%, but UBS believes that the company has the potential to deliver a surprise. Clarity on HVDC orders in energy segment and large tenders in mobility remains critical for this company. CG Power seems well placed to capitalize on continued capex-driven demand from industrial and power segments. We expect the company's top line to grow by 20%, margins to remain more or less flat, down 10 basis points. But Nuvama believes that the company's margins may remain weak for the next 1 to 2 quarters. We will also be watching out for clarity on exports ramp up with expanded capacities nearing completion. As far as BHEL is concerned, Bank of America expects strong order inflow of 30,000 crores this quarter. We anticipate a 13% growth in the top line and 380 basis points improvement in its margins. In fact, Bank of America expects EBITDA break-even from this quarter itself if execution momentum sustains. As far as Cummins is concerned, revenue growth of 10% is expected to be driven by robust domestic demand, but exports may remain weak given slower recovery in end markets. With rising share of CB/CP4 gensets, margins are expected to rise by 360 basis points on a YOY basis. Apart from that, management commentary around demand outlook, transition to the new norms and any competition-led margin pressures is critical to monitor. It is also important to see whether margin surprises as seen in the past few quarters is able to sustain. Most of these capital good players have seen continuous upgrades on account of the pickup in ordering activity, growth in the top line and profitability, which has driven a re-rating in the sector. Valuations, as you can see, for most players are above the 5-year average. Nevertheless, UBS has maintained its positive view despite expensive headline valuations. Additionally, Nuvama believes these premium valuations are warranted given the capex supercycle.